Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, we are back with another episode of Father-Son Finance. We hope to sound a little better for you with our new microphone upgrades. And today we're going to talk about retirement accounts.
Awesome. And we're going to talk about different types of retirement accounts, the ones that you can get at work or the ones that you can do individually.
Yeah. And before we get into all the nitty-gritty details, we want to touch on something that, especially in an election year, is super maybe important and kind of front of mind. It's definitely front of news cycle, and that's market volatility. And we saw a little blip of it now 3 weeks ago with the market drawing back, what, 3-4%?
3-4% in a day, but on the heels of a couple of downdrafts. So we were down about 8% from the July highs to the early August lows, and then we've since recovered those losses or early losses. Yeah. And that is just going to happen. That happens in the fall, especially as we get into an election year where there is market uncertainty, especially in a year when you've got the Federal Reserve who may or may not lower rates is what's going on in this cycle. 2 years ago, we didn't know how far they were going to raise rates. So there is always something, and it's just important for us as investors to realize that that is going to happen.
Yeah, absolutely. And I think in terms of kind of relating it back to retirement accounts, you see that on your statement. This particular one, actually, it happened at the beginning of August, so you may not see that
never even
pullback on your statement unless you're maybe logging in to your app online and looking at your balance on a regular basis. But that volatility can show up and really raise questions when a lot of times the retirement account is your longest time horizon account. And so it's really one that you should kind of let do its work and let the market recover and not make a decision based on one day's market movement.
And use the power of dollar cost averaging. You're putting in a little bit, usually you're putting in a little bit each month. Yep. And then sometimes which we'll cover, but sometimes your employer will make a contribution during this time period too. So, but with that, let's get into what all these numbers and letters mean, Louis.
Yeah. So we will start out in the employer retirement account world. And so that kind of encompasses your 401k, maybe your 403b or your 457b. And those are all accounts that are for retirement sponsored by an employer. The different letters and numbers are just different parts of the tax code. And so that's how those accounts ended up getting their name. So
yeah, it isn't anything sexy.
Yeah,
I mean it's nothing,
not very creative.
It's not exciting. It's literally just areas in the Internal Revenue Code that you can look up, and it will be under section 401k and 403b and 457b. So don't get too wrapped up in what the letters and numbers mean. Those are just the way you know that actually when you see those letters and numbers, know that that's a retirement account. That is for you to have an opportunity to set money aside for your retirement years.
And within those accounts, so the money is geared towards retirement. But what is the major advantage? The major advantage is the tax advantages that you get inside of those accounts. And I always like to talk about it as kind of an umbrella that shields you from taxes in those accounts. And I know we said don't get too wrapped up in what the code means, but just real quick, a 401k is what you are going to get from a private non-government company.
Right.
So
Baird is a non-government company that has a 401k.
Exactly. and the 403B and the 457, those are going to be your government sponsored,
So if you
typically nonprofit.
If you work for a hospital, sorry, go ahead, Louis.
No, yeah. For a hospital, if you're a public school teacher, or maybe you're a professor at UK, the government sponsored plans. So that's the difference in the numbers and letters. That's kind of what they mean, but they very broadly offer the same advantages to their participants.
And the reason these came about is because prior to 1972, 1974, there was most employers had a pension plan, and you did not put money into that, and the company might put money aside for you, and hopefully you work for them for 40 years, you get a gold watch, and they give you a pension.
Yeah.
Well, those really went away in the late 80s and early 90s, and we began this process of where you, the individual, had to start preparing for your own retirement. And so that's where these plans have proliferated. And as a result, companies and even the government, the hospitals and some of the other government agencies will match part of your contribution that you put in. And so let's talk about the fact that there are really, in today's world, two different ways to contribute. You can contribute pre-tax.
Yeah.
So you put money in from your paycheck. It is not taxed, and that will grow tax deferred, not tax free. Very different. You're going to pay the tax later, or you can pay the current taxes on it, and then that will go into an account that when you take it out, comes out tax free. So you might give a little more color on that, Louis.
Yeah. So typically when you are maybe logging into your portal to make your elections for your retirement account, it's going to give you two options. It's going to give you pre-tax, and it's going to give you Roth. The Roth, all that is a senator who passed a law that allowed for after-tax retirement contributions to these type of accounts. So a lot of times you're not actually going to see the words after tax or post-tax. You're going to see Roth. And so that's really all that is. And it's just a difference of, am I going to pay taxes now or am I going to pay taxes later? And really, there's arguments for doing either one. It's kind of a long math equation that depends on variables and answers that we don't have, including what's going to happen with tax law. Nobody knows what that's going to look like in 30 years. But traditionally speaking, the general thought is that if you are like me and you're young and you're in a lower tax bracket, the idea would be, hey, I should maybe pay the tax now because I'm going to be in a lower tax bracket. And maybe when I retire, I can take that out tax-free and I'll be in what would be a comparably higher tax bracket. So I would have won.
Right. And so conversely, putting it in pre-tax, I get a tax deduction, meaning I don't pay taxes on those dollars today. And so maybe I'm a little older in my career. I'm at a higher tax bracket. So I need that tax break in the current year. And then when I retire, perhaps I'll be at a lower earnings level and maybe a lower tax bracket. So the money will come out. And yes, it's taxable, but maybe it's taxable at a lower rate. Or if I'm in a high tax state and I move to a low tax state, I avoid paying any state income taxes. So Louis is right. There's lots of nuances to which one is right. I will tell you personally, I have used both.
Yeah.
I've used a pre-tax contribution when I needed it. I've used an after-tax contribution when I thought I could use that to my advantage. And there are lots of nuances to this. Let's talk about how much you can put in, Louis.
Well, and I want to touch on one more piece of that. So in terms of deciding pre-tax or Roth contributions, because it is so nuanced, you should talk to somebody about what may be best for you. Don't take what we've just said on being young or being older as advice. That's not advice. Those are just situations. But talk to an advisor about what may be best for you. And then one other thing I want to talk about that segues into how much you can put in is the employer match.
Yeah.
And so that is going to depend on how much you put in some scenarios. So in a typical 401k or 403b, oftentimes the employer will opt to match your contributions up to some percentage of your income. And so you want to talk a little bit about why they may do that?
Yeah, so that gets the employers will do that as an incentive. It's a benefit to you to work for that company, and they will match typically some percentage. Usually there's a lot of companies out there that'll match 3%. You'll have to check your 401k to see what they match, but 3%. So it's if you earned $60,000 for the year, 3% of that is going to be $1,800. So that's $1,800 that would go into your 401k that you didn't have to do anything for.
Yeah, you just had to work.
You just have to work, and you had to put in at least $1,800.
Yep.
So it's a really important piece. That employer match is important, and some companies will do more because they'll add on a profit sharing, so you get actually a percentage of the company's profits. All of these things are dependent upon your employer, and all of these things are a benefit from your employer.
And I think it's important to note whether or not you are contributing pre-tax or after-tax, the match portion of your contribution that is coming from your employer is always going to be pre-tax.
Actually, so that has traditionally been the case. There's some plans are updating where that can go in on an after-tax basis, but again, consult your plan. That's very, very new, hot off the press.
There you go.
With the new Secure Act is where that came from. So what are the contribution limits, Louis?
Yeah, so the contribution limits for these employer-sponsored retirement accounts are going to be, they're going to vary based on your age, but $23,000 is the max deferral amount for an employee. So if I earn $100,000 in a year, I can defer $23,000 up to of my income into that account.
And so if you are doing that pre-tax, then that means, just doing the math here, you will only be taxed on your earnings of $77,000.
That's right.
So that's the advantage. That's the incentive.
Now that changes a little bit once you hit the age of 50. And when you turn 50, you get what is called a catch-up provision where you can put in an additional $7,500. You can defer an additional $7,500 if you're over the age of 50.
So that's $30,500 that you can defer from your paycheck on a pre-tax or after-tax basis, depending upon your election or any combination thereof.
Yep.
And then your employer match doesn't count against that. So your employer match is in addition to that. If you are your own employer, then your max contribution for this year is $69,000. All sources, your contribution, your company's contribution to your 401k, to your retirement account. And if you're over 50, it can go up to $76,500.
Yes, and these are numbers that are adjusted for inflation, so these will change from year to year. But that is what they are for 2024.
All right, let's. So I think we've covered that pretty well. Again, check your plan document. Check with your human resource people. Check with your financial advisor, your CPA, what have you, because there's a ton of nuance to these plans. We just wanted to make you feel comfortable with what they are and knowing that those letters and numbers, while they do have meaning, they're basically the same thing. They're for you to save towards a later date of retirement. But then there's also another type of retirement account that you can use, which also came about in this 1972, 1974 era, and that is the individual retirement account. So you want to cover those a little bit, Lou?
Yeah, so there are two main individual retirement accounts. There is a traditional IRA, or there's a Roth IRA.
Same senator.
So same senator and same idea as before. The traditional, you're putting in money that is pre-tax money, and the Roth, you're putting in money that you have already paid taxes on.
And so,
Yeah, go ahead.
if I may, many of you will have come to know the IRA because you go see your tax preparer, your CPA, and they'll say you need to go put money in an IRA so you can get a tax deduction. And so many of us in the early years would go buy an IRA.
Yeah.
You don't buy an IRA, you set up an IRA and you buy investments in an IRA.
Yeah.
And so again, that's on a tax deductible type of IRA. It is important to understand the tax deductible IRA and the 401k or 403b are not interchangeable. If you have a 401k or 403b, you can only do pre-tax in that.
Yep.
And you cannot do a pre-tax IRA in a traditional. So you don't get a tax break for both.
Right. Yep. There are and again, this is why we tell you to talk to an advisor, but there are all sorts of income limits based on all of these numbers, but we're giving you the base idea of what these accounts are and how you may be able to use them to your advantage. The limitations on the IRA, meaning the contribution limits, are much, much lower than the contribution limits on your employer plans, and that's because it's on an individual basis. Ideally, you're taking advantage of your employer plan and your employer match, and then with money that you have left over, you're putting that into an individual retirement account. And so because of that, the limits are much lower. And this year they are $7,000 for an IRA. And they also do have a catch-up provision if you're over 50, which is an additional $1,000. So up to $8,000 can be contributed to your IRA in 2024 if you're above the age of 50. But if you're below, 7,000 is your maximum contribution.
Yeah, and so these type of accounts would be ideal for they can be used for almost anyone. I have an IRA. My wife has a Roth IRA that we're able to contribute to, as well as having an employer plan. That's just part of our personal retirement plan. But these are great for you've got a son or daughter or grandchild who's got a summer job. Maybe they made $2,000 or $3,000, $4,000.
Yeah.
They could actually make a contribution to either a tax deductible or a Roth IRA and have that money work for them for the next 40 years before they retire. And it could be powerful in terms of the compounding effect. So that's another way that those accounts can be used as an incentive. I know grandparents who have said, whatever you make this year, I'll match up to $2,000 for you to put in your IRA or Roth IRA.
Yeah. And so these also have these accounts, these IRAs have the same type of umbrella that shields them from taxes while they're in the account. And that's a vague statement. What that means is if you're comparing a retirement account to a traditional brokerage account, and so say in a traditional brokerage account, I were to buy Apple and it doubled, and then I were to sell it. And so I bought it at 100, it went to 200, and I sold it at 200, and I made $100. I got to pay $100 on the money.
You got to pay taxes on the $100.
Yes, exactly. Sorry, thank you for clarifying. I got to pay taxes on the $100 gain. In the retirement account, you do not have to pay taxes on those gains or losses when they're in the account. And then it starts to get into, well, is it traditional or Roth? When do I pay taxes on the way out? But while it's in the account, it is sheltered from those taxes on gains.
Yeah, and so it just gives you an opportunity. Again, the whole point of all of these is to put money away for long periods of time towards your retirement so that in your golden years, you can have a golden time. There are some other accounts that we have not mentioned. There are different types of retirement accounts that are specifically used for individual who have their own businesses and or small businesses, say under 50 employees. That's the SEP IRA, so that's the self-employed IRA and the simple IRA. We use the simple IRA as a very simplified form of a 401k for a business who has typically under 50 employees.
Yeah.
And those have their own different kinds of limitations. But if you hear those terms, they are in the same vein that we are discussing here today. There's always the pre-tax.
Yep.
Sometimes there's the after-tax, the Roth. But those are really the big picture terms that you need to think about and that I hope you'll take advantage of because they're out there and they're offered for you.
Yeah, absolutely. Well, we hope we muddied the waters there for you a little bit. Hope you learned something. If you have any questions, talk to an advisor, see what may be best for you and your situation.
And we look forward to seeing you next time.
See you next time. During this podcast, the following individual stocks were mentioned and discussed. Apple, symbol AAPL. Please note that Robert W. Baird Incorporated and Company makes a market in the securities of these companies discussed in this podcast.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird and Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird and Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.